Good day, everybody. As y'all know, I'm Brendan Snutter. I'm the wealth manager here at Alpha Capital. We stand at a new time and a junction all too familiar in the financial industry. It echoes of 1987 and 1999 and 2008 and even 2020. The sky isn't falling, but we have noticed patterns, indicators of potential changes, and demands our attention in the portfolios and the markets today. Today, we're going to talk about three key things that affect your financial well-being and the portfolios: economic conditions and how they're deteriorating from history, defining a recession and making sure that we're prepared for one, and reallocating our portfolios and the strategies that we are currently in and how to manage it during a recession. First, economic conditions are showing signs of stress. Many indicators are showing a high probability of a market correction. Our research has revealed that a pattern emerges through key historical data points like new home starts. So we look at it from years and years back of home starts, first-time home buyers, credit card defaults. All of these things matter because it kind of gives us a leading indicator of where the economy's going. And this is not a very good chart right here. So if you look at, first, let's look at the orange. Orange is the one that is first-time home prices. So what it's saying is the starter home price is actually peaked in 2023, a little after 2023, and it's dropped dramatically. So that means all of the first-time home buyers are not buying anymore, and they're actually having lower prices, or they're just not buying. So that's a very good leading indicator that we're not in a very good buying market anymore, and people are starting to have to drop their prices. Second is credit card default rates are starting to creep up in a big way. So we need to make sure that people are more delinquent than 90 days. So defaults in credit cards is creeping up from 7.5 to 9.74. That is not a good trend, and we're getting higher highs and higher lows. And when you start seeing that, it has a good trend that it's going to continue to go back up. Last is you're looking at U.S. housing starts is decreased down to negative 4.26% from a high in November of plus like 10. So this is a very, very concerning thing that they're not actually building more homes right now. So there's no buyers in the market. We're getting more defaults, less people are buying homes, first-time home buyers are not buying, and then home building and starter homes are not being built, and they're decreasing as well. All of these catalysts together leads us to believe that we're going to go into a recession sooner than later. So here's another economic indicator that has been relevant in the last 5 to 6 recessions. This is one that you really have to think through. So let me explain what the Treasury yields are. So it's natural in a normal market for short-term Treasury yields. This is the interest that you're making off of owning a Treasury bond. So if you own a 2-year Treasury bond and it's gaining, or you're receiving 3%, it's natural that a 20-year Treasury bond you should be earning 4 or 5% because the lockup of duration of time that you are required to hold that bond is higher, so you get a higher yield. So when it goes into economic uncertainty, consumers, institutions, and governments don't buy longer duration bonds because they know the Fed is going to raise rates. So they go to a shorter duration bond. While this is important, is what we're looking at is actually what they call the 10 to 2 yield spread. Showing on a 10-year Treasury, the price compared to a 2-year Treasury, and you're seeing the inversion. So meaning a 2-year Treasury is yielding a higher return than what a 10-year yield is returning. With that, now we can look at when this uninverts, and this is where a lot of people get confused or they don't realize that it's when it uninverts, because typically the Fed, the Federal Reserve, forced to reduce interest rates because the economics doesn't support a higher interest rate. And when that uninversion happens, if you look back to 1980s, 87, 1990s, mid 90s, the 2001. Even in 2008, we had an inversion of the yield curves. And now today is one of the longest we've had in the last 5 or 6 recessions. So there's high probability that when this uninverts here soon, we think sometime in the next 3 to 5 months, as Fed Chairman Powell has already announced that he's probably going to lower rates sometime this year. When that rate lowers and this uninverts, we're going to be pushed into another recession. With a looming deadline for the Federal Reserve and indicators of financial strain in the regional banking system, the question really isn't if, but when a recession is going to hit. The Federal Reserve Board announces to cease the Bank Term Funding Program March 11th. And on the surface, we don't expect this to be an exact indicator of a recession, but it's one thing that we're paying attention to. And we're also expecting a depletion of the reverse repo market between May and July. This signals tightening of financial conditions in the banking sector. A year ago, this was in the trillions of dollars. Today, it's less than 400 billion. Moreover, unprecedented layoffs and insider trading by some of our elected officials and the biggest CEOs of these publicly traded companies. Couple that with a Fed fund rate at an all-time high in the last 4 decades points us towards systematic risk. In fact, there is a high probability that the Fed lowers rates sometime this year. And here's the really great slide to actually help support that. This is the CME data that we're getting from the Fed directly. So if you take a look at the graph, from June, July, and September is the next 3 Fed meetings, where the Fed will most likely start lowering rates going into the presidential election. I think there's correlation there. And if that happens, bonds will directly benefit from that lowering of rates. And so if you look at our bond duration slide, that correlates with this as we get longer in duration, as there's higher probability of the Fed lowering rates. And so with that being said, this is why we're so bullish that by the end of this year, we're going to get the Fed to pivot, start lowering rates, which will make your bonds appreciate in value. This is not a guarantee, but it is highly probable that they'll start lowering rates. Remember, when the Fed starts lowering rates is the absolute triggering of a recession. They don't just lower rates out of the whim. They want a catalyst. They want to know that the economy is slowing down to the point where they are forced to lower rates. We can't ignore these warnings. It's critical to be prepared in case a recession does hit. And preparedness begins with understanding how a recession works and why it could be a good thing for our portfolios. What we need to do in the face of systematic risk, like a recession, is look at history. History may not always repeat, but it oftentimes rhymes. There's often valuable lessons for us to learn about investing. In these times of market volatility, precious metals and government bonds have historically offered the highest safe haven. So let's take a look really quick and consider what the 2008 recession did to equities markets. So I have 3 illustrations here, 3 different sectors. We're looking at the healthcare sector, the utility sector, and the financial sector. All 3 of these sectors, which are considered more defensive sectors, typically still had a pretty broad drawdown during a recession. The actual gray bar in the middle from 2008 to mid-2009 is the part of the official recession. If you look at those drawdowns, they're pretty significant. But if we flip over and look at long-term government treasuries in the first half of the recession, has one of the greatest returns out there. And this same illustration happens multiple times in 2001, 1987. So there's good history and pattern. So if we look at 2008 again, and we just look at the overall S&P, in the first, from September all the way into first quarter, you got a 37% drawdown in the S&P. If you look at precious metals from a fundamental standpoint, at the start of it actually rallied pretty huge of when they identified a recession, but then it actually drew down worse than the S&P at a peak of being above almost 30%, and then drawing down being almost lost negative 50%. That's a pretty significant drawdown. But if you pick up after the recession, when it bottoms, precious metals look like a great opportunity. And I personally think they might actually be on a super cycle for multiple years. But the major one you need to take a look at is very little volatility inside of long-term government bonds, with a 33.92% rally if you go back during the 2008 recession. And again, this is represented in 1987 and 2001. And so there's been other instances of the drawdown and the gains inside of a fixed asset class like treasuries for the next couple of years. So this is the position that we're taking. I'm encouraging all of our clients to have a conversation with this as quickly as possible and see if you want to reallocate your portfolio. Here at Alpha Capital, we've been strategizing meticulously with a proactive stance in our portfolios. Our goal is not to weather the storm, but to actually take advantage of it and emerge as a stronger portfolio whenever the market conditions pull back in their systematic risk. If you're concerned about your portfolio, preparedness of a potential market correction, we're here to help you. We want to have a great conversation with you, so please reach out to us. Contact us at 806-300-0401 or visit us at alphacapitalstrategies.com to book an appointment directly with us online. Together, we can navigate these challenging times, drawing on history's lessons to forge a path towards stability and growth whenever there's a market correction. I look forward to visiting with you soon. Thank you.